The UK government has estimated that some £400 billion of investment will be needed in infrastructure if the country is to retain its competitiveness by 2020. With me to discuss how retail investors can make money from this trend is Joseph Titmus, Portfolio Manager in the Global Listed Infrastructure team at AMP Capital. Thank you for joining me, Joseph.
Thank you.
So let's talk about demand. Infrastructure investing has seen a huge amount of money pouring in the last 6 months or so. Why is it becoming so popular now?
We believe that over the last few years, investors have been increasingly recognising the benefits of infrastructure as an asset class. Infrastructure is quite a unique asset class. It shares some investment characteristics with both bonds and equities. It pays out high dividend yields backed by sustainable cash flows that often increase at or above inflation, and they benefit from long asset lives. Investment in infrastructure has also benefited from the demand from governments to try and stimulate their economies, and it's also been in something of a sweet spot with the global macroeconomic trends of late, quite low bond yields and some uncertainty or volatility in global equity markets.
Interesting. If a retail investor is watching and they think, I'd like to invest in infrastructure, how can they go about doing it? What are the channels through which they would need to invest?
Probably the most popular method that we've recognised of late has been through global listed infrastructure funds. Alternatively, people have also been using ETFs to get exposure or investing directly in an infrastructure company listed on one of the stock exchanges. But by far, the most popular that we've seen are the global listed infrastructure funds that put together a globally diversified portfolio of infrastructure companies benefiting from those trends in the growth in the asset class.
Okay. And how does infrastructure investments differ? How are they distinguished from, say, a traditional equity or debt investment?
In a couple of ways. So, like I said, they do share some characteristics with both of those asset classes, but also they're quite lowly correlated. So they bring good diversification benefits to an investor's portfolio. It does share the high yields that you'd associate normally with fixed income, but it also has some growth, which you'd probably be more familiar with from equities. Probably not to the same extent, but you'd probably see lower peaks and lower troughs. More stability is what we'd expect over the long term from global listed infrastructure.
Mm-hmm. And how do you see the market evolving over the next 6 to 12 months?
Over the next 6 to 12 months, there's undoubtedly going to be some sort of further volatility or uncertainty. The world's in an interesting place at the moment, but that's natural for listed investments. We believe that investing in global listed infrastructure is for the long term. These are long-term assets, and over the long term, we expect good returns from the asset class, and probably to reflect quite stable and low correlations to global equities.
When you say long term, how long would that be roughly? We're talking 10 years, 20 years?
Longer even. So some assets have concessions that go beyond 20, 30, 40 years, even up to 100 years. And then other assets that are owned by companies are constantly being renewed. These are assets that provide essential services to the economy and are going to be needed for some time.
What about geographical trends? Can you tell me a little bit about some differences in infrastructure investing across the globe?
Sure. There's 3 main trends that's driving investment in infrastructure around the world today. In developed market economies, we're seeing a lot of investment in infrastructure in order to try and stimulate the economy by creating jobs. Also, the infrastructure is in quite a dilapidated state. So we're seeing investment renewal, a lot of maintenance capital expenditure in order to bring those infrastructure assets back up to a reliable state. Whereas in the emerging market economies, there's a lot of investment there to try and close the gap in standard of living between there and the developed world. A lot of growth as well, just from the demographics there in those parts of the world. In terms of specific regions, in Europe, it's very much the case that infrastructure is being used as a tool to try and stimulate the economy. Whereas in North America, investment there is really being focused towards the energy industry and the shale gas boom that we're hearing so much about. Australia as well, to an extent, there's some investment in infrastructure there related to the resources boom that they've been benefiting from.
And what about Latin America? Are you seeing much infrastructure investing going on there?
Certainly, yep. All of those countries are seeing a lot of investment. In particular, in Mexico, we're quite positive on the prospects there. The new government is particularly reform-minded and is very keen to stimulate growth from infrastructure, and the economy there has been growing quite well. Brazil too has been investing in infrastructure quite significantly in recent years. They've got a couple of big events coming up with the Football World Cup next year, and the Olympics in Rio de Janeiro shortly thereafter. And Chile, of course, Chile's quite an interesting economy. They've been benefiting from the resources boom to an extent as well, and their economy has been performing very well and has needed further investment in infrastructure to sustain that.
So what level of total return could an investor expect on an infrastructure investment, and how does that compare to, say, fixed income or equities?
From global listed infrastructure funds, much like our own, we're expecting returns in the range of sort of high single digits, low double digits over the long term. And that's been pretty indicative of what we've seen over the last 10 years or so, where we saw returns around 14%, 14 sort of 15% levels. Of that return, you get a dividend yield of around sort of 3 to 4%, and the rest is coming from the capital appreciation. So, quite attractive returns when compared to global bonds or to global equities.
And so which companies are you currently bullish on at the moment?
Companies we're bullish on are companies that benefit from sound regulation or have an interesting growth dynamic. For example, in Europe, we quite like the European airports. Everybody's heard about the economic challenges which Europe has, but airports benefit from global macroeconomic trends, and there's been a fair amount of growth in emerging markets in recent years, and a lot of people travelling in those markets to Europe, and they're travelling through the major airports like Frankfurt or Paris. We quite like both of those companies. In the UK, we like companies here that are benefiting from sound regulation. Two companies that, for example, National Grid, a large gas and electricity utility, or Severn Trent on the water side. The UK has very sound regulation, political and tax and legal structures, which we quite like for our investments. In North America, we mentioned the shale gas trend, and we like companies that are exposed to that, companies that are owning gas and oil pipelines like Kinder Morgan or Sempergrid.
And what companies are you currently less optimistic on?
We're less optimistic on companies where there's more regulatory risk than what we'd like, or companies that are looking expensive. So they're pricing in more growth than we'd normally expect. So, for example, emerging markets, we've seen a number of companies there, share prices appreciate above what we'd expect. And in Southern Europe, there's companies there that are exposed to more regulatory risk than we'd normally be comfortable with. And a large part of what we do is assessing that risk and making sure that our portfolio is not unduly exposed to risks that we'd prefer to avoid.
What are the risks for retail investors if they're looking to invest in infrastructure? What do they need to be careful of?
We think retail investors should be careful about getting what they expect from their investment. Infrastructure can be quite a broad term. It can be quite a broad asset class depending on the definition. We take quite a core and pure definition to infrastructure. We only like investing in infrastructure companies that own and operate the assets. We don't want to take undue risk, undue competition or commodity risk that you might get from investing in a company that you think is infrastructure, but really has more construction risk or has more commodity risk, oil price risk, for example. So we're very much focused on the more defensive owners and operators of infrastructure assets. So I think investors should really be careful about what they're investing in and making sure that that what they are investing in meets their expectations.
Thank you very much. Well, that brings us to the end of this episode of Digital Look TV. Joseph Titmus, Portfolio Manager at AMP Capital, thank you very much.
Thank you.
And thank you for watching.